your issues. I wanted to come online yesterday already to talk to you guys about stable coins. And what brought this on was a journalist that I used to work with in the past emailed me, and she wanted to know about a company called Carrot Bars, because on Monday, our financial sector conduct authority issued some warnings around the scheme, and there have been warnings issued by the likes of CoinDesk and CoinMarketCap around this particular company. They started off being in the gold business and got into the crypto space, I suppose, sometime last year, because last year they launched a gold backed cryptocurrency called Carrot Bank Coin or Carrot Gold Coin. Um, KBC is the token name, and it's traded on a number of exchanges. And the journalist wanted to know whether there was any truth to the warnings, etc. And I replied to, and I thought it's a good time to talk to you guys about stable coins, um, because the KBC coin is a stable coin, a stable cryptocurrency. And okay, so what is a stable coin? A stable coin is a cryptocurrency, the value of which is intended to remain stable relative to the price of something else, or its value is pegged to the price of something else. It could be pegged to the price of, say, the dollar, as is the case with something like Tether. It could be pegged to the price of gold, as in the case of KBC. It could be pegged to a basket of currencies, similar to what Libra is trying to do. You can create all kinds of concoctions of stable coins. But that is the crux of the matter. And we have stable coins today because people can't stomach or do not have the appetite to handle the massive price swings in the value of these particular cryptocurrencies, right? So stable coins were designed for people who don't have that kind of risk appetite. But there are a couple of things wrong with stable coins, okay, which I'll talk to you about now. And this is why I would never personally recommend people go anywhere close to these stable coins. So, firstly, the idea of creating a stable coin, the value of which is pegged to something else, is really bizarre, because the price of the coin is a function of supply and demand. Okay, that is an economic phenomenon. The price is not something that is intrinsic to the coin, or it's not an attribute of the coin that you need to solve for. So fundamentally, trying to create a stable coin is solving for the wrong problem. Okay, that's number one. But let's just take a step further. How do you manage the stability of the price of the coin? Well, you do this by having a reserve of whatever it is you're pegging the coin's price to. So in this particular case with Carrot Bars, there has to be a reserve of gold, all right, in the background. And this reserve of gold is managed in the following way. Let's say, for example, your coin, which now has been issued, is trading on a number of exchanges, and people lose interest in the coin, or they need to sell the coin to get some cash. And the price of the coin then subsequently drops because of the selling pressure. Well, what happens is the guys in the background who are managing these reserves are going to have to buy up those coins using the reserves that they have, right? So in other words, they need to drive the buying to bring the price of the coin back up to the target levels. So now what happens when people have been selling and selling and selling the coin, and the reserves are being depleted because you're trying to buy up a coin that no one has any interest in, and your reserves get depleted? The whole thing just starts falling apart. And then even more bizarre for me is stablecoins. It is such it's a bizarre and convoluted application of blockchain technology, right? As I was just saying to you, the way in which you manage the price stability of the coin comes from the way you manage the reserves in the background. Blockchain technology has nothing to do with it. It does not really add much value, except for, well, it adds costs, but it does not add much value to the system. And therefore, it really is an unnecessary additional piece of technological complication to the whole process. I mean, the process of managing the price of a stable coin is no different to how central banks manage the value of their currency, their domestic currency. And they do this by intervening in the currency markets and buying or selling their domestic economy using their forex reserves. There's nothing new about this sort of thing. And as I'll talk about later, some of you may know this, currency pegs do just not last. Okay, it is a very difficult thing to continue to try and manage. And then I suppose the one other thing that I just want to mention is that if you guys are considering investing in a cryptocurrency, a stable cryptocurrency, the price of which is tied to something like gold, you may as well just invest in the gold directly, or you can invest in the dollar directly. Why buy the token that represents a claim on the asset when you can have the actual asset, number one? And number two, by buying the asset directly, you cut out about two middlemen in the process. You're cutting out the token issuers who are going to be taking a huge chunk of costs in the process for managing those reserves, and you are cutting out the cost of the Ethereum blockchain on which your tokens are being managed. And it's no secret, the Ethereum blockchain is a heavy and expensive piece of infrastructure. All right, so think about those kinds of things. Now, perhaps let me just close off with what I think is an interesting story about how George Soros broke the Bank of England. I think it was back in 1992. It's a nice story to tell because it serves as an illustration of how trying to peg the value of a currency to something else is just not sustainable. So in the early 90s, after England joined the European exchange rate mechanism, um, the idea was to keep the value of the pound against the Deutsche Mark at a certain level. It was around 2.95 Deutsche Marks per pound. And the pound was allowed to vary 6% up or down from that particular target. But the currency traders could see that the economic situation in England was not good. And what they started doing was they started short selling the pound. That put a massive amount of downward pressure on the pound. And the UK prime ministers and others gave the Bank of England authority to spend billions of pounds in an effort to drive the price of the pound back up. George Soros was one of the major currency traders during that particular time. And the currency traders just kept shorting and kept shorting the pound. And eventually, I think the number was just over 3 billion pounds of money that the Bank of England sunk into trying to peg the value of the pound. They gave up. And eventually they had to abandon the exchange rate mechanism and allow the pound to find its value based on what the market deemed it should be. That was a very, very expensive exercise. And George Soros made something to the tune of around $1 billion in the process. Now, that is the famous story of how George Soros broke the bank. And it just shows you, trying to peg the value of a currency in our floating exchange rate regime it is just not sustainable. And it's the same thing with the cryptocurrencies, guys. You are solving for the wrong problem. You could argue that having stable coins in our ecosystems make people more comfortable with the notion of cryptocurrencies. But this particular solution, I would urge you guys be very, very wary of it. All right. Anyway, thanks for listening. I'm going to head off. Ask us some questions, leave some comments. We would love to hear from you guys. All right. Really hope you guys have a lekker day. Lekker is an Afrikaans word for nice. Have a good day, chaps.